Hi everyone, Nick here, looking at 2020. Yes, the whole year. My personal goal is to trade less, but with better conviction. Hopefully we move away from headlines. This is when you can do that. Otherwise, I always worry about the headline just from the short-term perspective. The headlines don't change anything in the price action. They actually just expedite the breakouts or the breakdowns from the necklines. So the price action usually unfolds the way it has to unfold, because as we're moving to machine trading more and more, I think 80 or 90% of all trading is done by machines, then it becomes more predictable. But the timing, if I'm playing short term, more likely to get burned on the headline than long term. So having said that, we've been bullish when everybody was bearish. So this is the SPX 1 year. All year long, everybody wants to retest the lows. And, my message has been pretty consistent. What are you shorting, basically? The Fed is on your side, so they say don't fight the Fed. Everybody was fighting the Fed. The tape is on your side. Don't fight the tape. Don't fight the dull market. What do you call it? Rising in a hailstorm. So you've got everything going against you, and you're still rising. So what were they shorting? Plus the P&Ls, which is the most important thing, because the SPX is just a collection of a whole bunch of stocks. So Apple P&L was healthy. Google P&L was healthy. Facebook was also healthy. So all of these guys, which comprise at least those 5 or 6 companies, are more than half the NASDAQ. So what are you mathematically shorting? It's hard to see a debacle without a new set of circumstances. So it needs a black swan, but that happens at any point in time. So it's not a tradable thesis. So all I've got is the chart in front of me and the overall thesis. Will it extend to 2020? So my goal for 2020, I shared at the end of 2019, is that we're going to have a few good days, a mini drop, and then another new high, however long that lasts, and then a big correction at some point in time during the year. So we're going into an election year. So for it, the macroeconomic conditions completely change. There has to be a major change. Trump going out of the picture is a major change. Not for the better, because markets don't like change. Whatever is going on, however crappy it is, they want to know that they know what they know, and there are no surprises. So even if you had bad jobs, they can live with it. They just want to know that there's no change. So in this case, if there's a change in the White House, that's just a new set of questions. It will cause volatility. I'm not saying that the market will crash, but it will change the givens. So I would have to back off my thesis. If there's no change in the White House, if there's no change, some company going out of business, if Boeing doesn't crash, which is a big question mark right now. I can't believe that company. Wow. There is the macroeconomic conditions are going to stay the same, so I just trade the charts. And on the charts, there are clear lines I can draw. I'm going to put the lines in and then speak to that. So these shaded areas, this is just called a pitchfork. I don't use it often. I don't use it to trade. It just gives me a visual reference of the channels we're in. So we're rising, and we're inside a tight channel. So the risk is falling out of a channel usually. But there are a lot of lines in between then and now. So the first line is just around 32.0506. Let's call it 3200. I remember when that was like, what? Are you crazy? We're going to 3200 when we were down here. And now the headline's like, oh my God, we fell down to 3200 the other day on the night of the bombings. So just perspective, I should say. So 3200, let's call it for a round number. 3160 sticks out. 3120 sticks out, because this was a target. 3070-ish, maybe down to even a better number is 30. There's 3040 something. If I'm trying to remember from memory, 3036 for some reason it sticks to mind. 3015, 3020, probably the most important one. So why? Because if we fell out of a channel, then this would also be a nice visual place to rest. This was the neckline from which we broke out in October. So let me extend it a little bit. Can I get a little smarter? So this is the same chart, only a weekly look at it. I'm trying to find, okay, so the accident in October of 2018, that's when the Fed said we're going to keep raising rates. We fell apart, right? Big correction. We came back to it, exactly, we failed. We came back to it, we failed. We came back to it, we failed. We came back to it, we broke out. So it's only logical to expect that if, for some reason, we have a big correction like I'm expecting sometime in 2020, I don't expect it to go below that level. So the neckline from which we broke out last year should be a solid support with the same macroeconomic conditions. So I will buy the dip. So when I say, oh, we're going to correct, that doesn't mean I start shorting left and right. It just means I book profits along the way, and maybe I take a few protective puts somewhere or buy some fixed calls. So the plan is keep riding, finding the individual breakout charts. Like Twitter paid pretty quickly. Netflix even paid. Google really paid this week or last week. But it was tactical. It wasn't an investment. It was tactical. Facebook was an investment, and it paid really big. That's like 2-3 months old. It's more than the triple for whoever held it that long. So I find exact breakouts. I can trade them, but I have to be tactical about it. I don't fall in love with it. I book early. I don't care. So I'm going to share a set of videos, each with a specific thesis, and I can tell you the summary of it. I want to buy the dip whenever it happens. When is it going to dip? Usually early February it may happen. And if it does, it'll be smaller than later. Maybe we will have one in April. That will be bigger. So I will buy either of those two from a trading perspective. And it depends on how far we fall. If we fall to 30.65, I will buy it harder than when we fall to 31.50. And if we fall to the accident scene, so this consolidation zone here, I will definitely buy it even harder. So as long as, on a weekly basis, as long as we're above 30.20, guess what? The buyer is in charge. What? Yes. From a weekly perspective, if we're above 30.20, 30.30, the buyer is in charge. So another theme is the TLT. What is the TLT? It's the representation of, quote, bonds. So when people say bonds, I'm buying bonds, I could emulate that by buying the TLT. So it's not the yield. If the yield rises, the price of the bond falls. That's always the case, and vice versa. And then usually bonds go an opposite way direction of stocks, but it's not. I bet you I can find a mathematician that would prove me wrong. There is no correlation or inverse correlation. Whatever, to me, is you hear it all the time. Do I invest in stocks or do I invest in bonds? So they're competing for money. So, and when stocks fall off a cliff, bonds spike. So I bet you this will coincide with the bombing. So I'm going to show you. I'll put in the SPY to compare it with. So dip, rally, dip in bonds, rally in stocks. Dip in bonds, rally in stocks, that orange line. So there's no doubt that, at least for the short term, that it's a safety trade. When money wants to flee stocks, billions of dollars are managed by money managers, but they have bosses that tell them what to do. So they tell them, okay, invest in the stock market, but in tech or in whatever, X% in tech, X% in cars, X% in retail. And but what these guys are doing, and girls, is if the poop hits the fan and they need to bail out of everything and park the money, they usually send it somewhere else. And they don't have permission to maybe take it to cash or take it to another sector. What do? They buy safety. They buy yen. They buy bonds. Don't ask me why, but that's how it works. So why do I want to bet on bonds all year long? I could sell put spreads all year long. I had a put spread for this week, next week, the week after, or 3 months down the line. Depends on how active I am. Because you've heard the acronym TINA, which is there is no alternative. So giant money in Europe wants to buy safety. They're not allowed to invest in stocks, for example. Well, if they have $10 billion, what are they going to do with it? If they buy bonds in Europe, they're going to pay money. There's negative rate. You've heard that? Negative rates, which is like, bad economics. I lend the government money, and then the government says I have to pay them money to lend them money. It just doesn't make sense. So there is no alternative for these guys over there. The acronym is TINA, but to come and buy U.S. bonds. Not because they're safer, but they're not negative. They actually pay, 1.8 on the 10-year? Probably over 2. I haven't checked on the 20-year. So there's no alternative for them. They have to keep buying our bonds. And the Federal Reserve is no longer lightening up its balance sheet. So that's a good thing too. So from that perspective, even though bonds fall on good day for stocks, I bet you it'll find a floor. Case in point, this is a daily chart. Bonds fell and they keep holding the low. They keep holding the low. This rally was insane, shorted it. So I don't expect upside. So I don't want to buy calls in bonds, but I want to sell fear of the disaster in bonds. The people that keep expecting the bond bubble to burst, it will burst at some point maybe. This is a weekly. This is a monthly. But I know there are a whole lot of lines, but there's a floor because somebody's going to buy them. There's a big demand on them. So 128, exactly where my cursor is on the TLT, looks like an excellent place to buy it in case of a disaster in bonds. I will go all in at that point in time to try and catch a falling knife with a tight stop. This is a monthly chart. So each candle is 1 month. So this, just to show you, 08 crisis is right here. Bonds spiked. And then the 2010 crisis, the 2011, then the flash crash, remember that? And then whatever happened in 1014, I can't remember. And you can see how they keep edging. The 08 crisis was a disaster. Here we are above it. And just from a chart perspective, cover the name. This chart has excellent support at 120. I mean, like bulletproof support. Because if I look left, this is the volume profile. That orange line is automatic from the system, from my chart. So this is all the volume of buyers and sellers. They've been most active in this zone right here. And if these bars down here are volumes, but when they happened. These bars over here, the yellow things and blue things, are also volumes. Same information, only where they happened, at what level. Which tells me that every time price goes through this zone, buy, sell, buy, sell, buy, sell, busy, 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 busy. So this cluster right here, they've been the busiest. This point right here, the absolute busiest since 2006 on. So if for some reason bonds fall here, guess what? They're going to be buying, selling, busy, 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 and that's like putting the brakes on a fall. That's why it's support. Back to the point, TINA is in full effect until Europe. Christine Lagarde is the new ECB head, no longer Draghi. She's untested, but the last time she spoke, she sounded just like Draghi. So unless she goes to positive rates, that would be a bad day in bonds and probably sustainable. But somebody there, I can't remember his name, said that they're not even thinking about it. So negative rates it is. Therefore, U.S. bonds are still more attractive. So that's the spirit for 2020. Stocks can go higher and will set new highs. Stocks will correct, but buyable dips, and depends on my timeline, where do I buy them, and depends on how it unfolds. Okay. NASDAQ is too high for me right now, and because of Netflix scares me. Netflix reports next week, the week thereafter, so first FANG stock to report is Netflix, and I'm afraid from a nasty reaction if they have bad growth overseas. Disney hit the market with their platform. We don't know how that's going to affect Netflix, so it's a big question mark. If Netflix rally, then the NASDAQ is fine. So if I wanted to bet on Netflix earnings, I should probably buy QQQ or an NDX to throw a blanket long on all NASDAQ. So if it rallies, they all rally. And if it fails, then the QQQs will fail less than Netflix. And the earnings for Facebook, Google, Apple, Amazon are coming later. So at least there's still some premium left in my Qs. So I can go long Qs, maybe short a little bit of Netflix for the lottery put spread or something to hedge my bet. But that would be the way I would play it for the next couple of months, at least next month, 3 weeks or so. The one thing is the RUT. So this is the small caps. Believe it or not, the small caps have not made a new high. In fact, their new high was in 2018 in August. It wasn't even in October. Everything fell apart in October for the rest of the market. They were stars until August in 2018, and then they just collapsed. Everybody's waiting for the catch-up trade. I get it. Mathematically, it should be up here somewhere. So they have room to go to 1800. I'm waiting for them to go to 1800. Will it happen before the market corrects or not? So there's a buyable dip there. This has been pivotal level around 1610. Let's call it 1600, 1620, 1600, 1620, pivotal. For a long time. Failed here like hard. Was the breakout here. So if I were to guess, this would be a buyable dip down to 1610-ish. If not, this whole cluster is very strong support. Look how many weeks, each candle is a week. Look how many weeks of consolidation. So that's a really good base for this bull right here. So this bull can continue with a little dip. So what if in February we get a small dip, maybe even as early as next week? 2, 3, 4%, that's a dip I'd buy. Okay, but if the dip comes later towards May, I bet you it'll be much bigger because it'll be from higher point. So if nothing happens, I don't know why these guys are lagging so much, but you know, they have energy in there. They have probably 20% of them are called financials. So which is the risk next week. Next week, the financials report or start reporting, and that's the XLF. It hasn't been this high in a long time. I'm afraid for that. They're above a neckline, so they better hold that neckline. JP Morgan, Goldman Sachs now suddenly is trying to change its model. So this right here is my guess of what's going to happen to Goldman Sachs, just based on this is exactly the same chart pattern that happened a while back. I copied it and moved it over to here to see if it's going to repeat itself. This happens every once in a while. So far, it's been rallying, but if I look left from this spot in Goldman Sachs, it's a ledge. So don't know if they can bust right through it. And next week they start reporting earnings. And a hiccup in Citigroup, for example, is going to be disastrous in Goldman Sachs. So this is the area where I copied that price action. These three bubbles, they were that bad for Goldman Sachs. So we have had 2 bubbles. That's 1, 2. And my guess that we're somewhere around, we're trying to start to price in the rest of the head and shoulder pattern. So maybe it happens, maybe it doesn't. But this is speculation on my part. So if I wanted to buy a few puts in Goldman Sachs, number one, I would as a lottery ticket, so small size, because I don't have anything but the chart as far as conviction, with a stop above 245, 246. Or if I'm long Goldman Sachs, I would book some profits. So that's my opinion on the Goldman Sachs and the financials. So next week, RUT, that's the reason I mentioned them, has the potential to fall because of the financials. If not, then we take off. Maybe we'll set a new high. In fact, I'm going to do this, add an alert for myself that if we go above this line, 1685 plus, folks, we might be headed to finally set a new high for the small caps, and then maybe the whole market will correct a little bit. How much? So Fibonacci is a mathematician, and let's assume that the rally goes to here, 1780. The 50% retracement is right here. So that will make a nice round number. So 1780, I'm going to remind myself. 1780, then correct 50%, question mark, to 1620-ish. All right. This is how I'm going to leave it. So the point of this video is to give my opinion of the 2020, how it's going to unfold. Nothing has changed. I should have started with that. We're still bullish. The buyer's in charge. We will have dips. They will be viable. I pointed out my levels that I see in the SPX. I also said I'd rather buy the dip than just keep anticipating highs unless I have specific breakouts like Zscaler this week, a little breakout, or Netflix the other day, or Twitter the other day. So that's one way. And then we talked about the lagging small caps, no new high. Maybe next week the financials will deliver, but the expectations were really high. So if I were to guess, there's going to be a disappointment in financials. There's going to be a disappointment in Netflix. Those are guesses, wild guesses. So maybe the small caps don't have the high. But if the financials deliver, the small caps will set a high. The whole market will rally. We'll get 330 in the S&P. And then we will top off when the Nasdaq, the small caps hit 1780-ish. And then we dip. How far? Maybe down to 1610, 1620, which would be a good sizable dip. 5% or so, 6%. Small caps usually run a lot faster and deeper than the broader market. So anyway, these are my two cents on the matter. Long video, I'm sorry, but I've been meaning to do this and I keep postponing, get busy. I'll try to send out individual write-ups for these concepts, TLT long, all year long, unless Christine Lagarde raises her rates, goes from -2 positive or something. So hopefully this was informative. Nick signing out.